class. All right. So anyway, that's a brief introduction of the way the session will run. I will try and make it the third Saturday. I think in November, it may not be the third Saturday, but I'll let us know. But October will be the third Saturday. So that for consistency, people can also plan their time along that lines. So for today, we'll go through introductions and go through some fundamentals on planning. When I say introduction, I introduce Arawa, those on the line so that you know me and you can also see who else is on the line or in the class. And then we'll go through a small, I think it's about 10, 15 minute short audio training that I will play, and you should be able to hear it online. The teacher in that subject is Brian Tracy. It's one of my favorite authors. The things he talked about, I think he presents it in a way that will be very valuable for everyone to hear. So I'd like to play it, and then we'll talk about it differently. And then in the course of the program, there is a 6-step financial planning process that I will go through. And then today we'll go through or talk through time value of money, as well as compound interest. Kind of lay some foundation. The class today is very, very foundational, but it's critical towards the things that we'll be learning in the course of these sessions. Okay, welcome, Buki. All right, so I think a couple of more people have joined. So let's just have a quick introduction. So my name is Larry Olabinjo. I started this class a couple of years ago in the bid to kind of actually share some things with our own children. And people were very interested, so they told other people, and we got people that were attending, the class. So I had a break for some time because I was pretty busy, but I really, felt I need to kind of get back to it because I had some positive feedbacks and testimonies that people share from the class. So I want to make sure that it's a blessing to as many as will participate in it. I just want to say one thing, what you put into this kind of material that we're going to be sharing in the course of the next few classes is what you're going to get out of it. What you put in. If I ask that you do an assignment, I strongly request that you please do it, because it's the way to kind of solidify your level of understanding on those material. And then you can come to the next session with questions or even contributions. It's more than welcome if people come back with contributions. Okay, so my name is Larry Olabinjo. I'm a minister in Redeem and the Redeemed Christian Church of God. I see a lot of gap when it comes to the understanding of money. That's why, Hosea 4:6 says, my people perish for lack of knowledge. So I see a lot of opportunities, especially if people have a good understanding of this and you take advantage of the knowledge early. It's not only about knowing, it's about what you do with the information really that makes the difference at the end of the day. So I want to say, please do the assignments as you go through it. Number 2, the things that you will learn out of this, take action. Some of that you will see why I say so in the course of the next few weeks. So it's not going to be weekly, rather it's monthly, but so in the course of the next few training sessions, I should say. All right, so there are a number of people online. Let me just go ahead and get started with this. So let me start with this basics, as it were. Talking about financial independence, I've been, thinking about this and talking with people about this, quite a bit. And I realized that when it comes to mastering money or understanding how money works or understanding and having results in the area of finance, there's a lot of emotion involved. And really, at the end of the day, it's about mastering or understanding your own emotions more than anything else. You want to, as much as needed in this kind of subject, it's really critical that you have a clear understanding of what money means to you. What are your values when it comes to money? I believe everyone can see my slide. What does money really mean? Try to understand that is critical. I feel as a child of God specifically, one of the things money does is it gives you the opportunity to be a blessing in the kingdom to people, of course, to your family. So that is my own kind of self-concept. And each person might have a different self-concept when it comes to money, but you need to know what does that mean to you. And these bullets in blue, the next one here, I just want to kind of, emphasize on that a little bit. That I think most of us on the line, probably you work for someone, there'll be some people participating that are self-employed, that you have your own business. I tell people this all the time. You need to, even if you work for someone and you're an employee, you need to consider yourself as being self-employed. Regardless of who signs your paycheck, you need to act as if you are self-employed. That is, you must learn to make the most of what comes in and what goes out. And you're not just kind of focused on money coming in. How do you manage it? If someone runs their home business, they are very, very focused on understanding how do they manage that fund effectively? How do they plan? There's a lot of planning. There's a lot of long-term goal setting, and that's the same thing where you need to consider your financial life. When it comes to money, one thing I like to say to all of us, today is that we need to have a strong understanding of our motives or motivation. Why do you want to be financially independent or successful? There are many people, I say this very, very with all humility. You have people that are at the age of 60 and they still cannot stop working, or 70. It's okay to keep working if you want to, but if you can't because you have not laid the right foundation, I think it's not the right thing to do. And many of us, I'm sure, are probably at a place where, you have some understanding of what you want in the future, but maybe you've not really kind of thought through how do you get there. So having a clear understanding of the whys of what you want to do here is pretty important. I will not spend too much time on this. I just want to lay a little bit of foundation as we get into this. Why, the goals, why is it important to be financially free? Not that we are still at an advanced age and you're not able to stop working simply because we've not laid the right foundation, So one of the key things I always tell people is that when you have a strong why, it allows you to kind of have a good, at least the ability to, know what you are giving up and why you are giving it up. Because the process we are going to go through in the course of this couple of training sessions will require that you make some, I don't know if sacrifice is the right word. Once you know what you want to get to and you understand what it will take to get there, the question is, are you willing to make those short-term sacrifices that you can achieve your long-term objectives? So your why is really critical because it impacts your motivation. It impacts your ability to move forward on some of these things. One important point I want to kind of say here is that, and it's unfortunate, regardless of the level of income of many people in this part of the world, and even in the West generally, most people are maybe about 2 paychecks away from becoming broke. So 2 paycheck. That's really sad. It's really, really sad. We should not live our life in such a way that if you're not going out to work on a daily basis, then you are unable to meet your financial obligations. And the truth is, if you lay to heart some of what I'll be talking about in the course of these sessions, you can set up your life in such a way that is not your own reality. And I pray that will not be your own reality in Jesus' name. And it requires that you understand how to manage your finance, not just work, pay bills, and all of that. There are some very basic things that you need to understand. There's what is called Parkinson's law. I just briefly speak about it. And the law says that expenditure always rises to the level of income, that people spend always to the level of whatever they earn. If someone is earning 10,000 today, they will be at that level, but if their income increases to 30,000, somehow they will make their expense to also come on to that level of expense. That is not a good way to live. If you live like that, then you have no way to really invest. At the end of the day, it's through investing that you can become financially independent or financially free. So it's critical that we don't allow Parkinson's law rather, to be our reality. That requires that we understand and manage a couple of things very, very well. And it's really sad. I think I've said this for those that have been in the training session in the past. We have some new people that joined us this session. But those that have been in this session in the past, you know that I've always said that, look, even those that earn, millions of dollars, you have some of these football or sports stars, they'll earn millions of dollars during their active years. And then, they will become broke. They'll get to a point in their life that you find out that they don't have enough. Why? Because it's never about how much you earn. I say that all the time. Most people spend their income on, you learn more on some of the financial terms if you just join in the class. You spend your money more on liabilities, things that take money out of their pocket. I saw one of these sports guys sometimes, they show this closet full of shoes. I'm like, how many of the shoes? There's nothing wrong with buying shoes, but how many of those are you going to wear? So it's not ever about how much you earn. If you allow your expense to increase at the same rate as your income, you can never be financially free, financially successful. It's important to keep that in mind. Okay, so keep that in mind. As your income increases, the delta and the increase should go into what I call your financial independence account. All right, so once you understand your why, you have a feel for, I need to kind of think through this plan for the long term. The question then is, what do you want to get? This is really the meat of what we're going to focus on a little bit today. The what. How much do you want to earn, from all sources? What do you want to have, let's say 5 years from now, 20 years from now? What do you want to have in total assets at that point in time? And it's unfortunate sometimes, I feel, that in the church we don't talk about, planning and money as much as I think we ought to. And I think it puts a lot of people at a disadvantage. I think it's very, very critical. It's okay to pray about things, but the things that we must do, we can't lay it on God and expect God to take ownership of it for us. We need to do what we ought to do. We need to play our own part, and that includes planning. The Bible says that every house is built by some man. A good enterprise is built through wise planning in another scripture. So you need to have an understanding of what do you want to have. Let's say you are at the age of 20. Some of those that are going to be attending this training, I know at least a couple of the participants are going to be in their 20s. I think they have an advantage that many people don't have. They have the advantage of time. However, I tell people, whenever you wake up, that is your money. Even if you don't have the privilege or the advantage, it just means that you need to work a little bit harder than someone that starts early. So thinking about what you want for the long run, let's say you are at the age of 25, when you retire, let's say at the age of 60, where do you want to be financially? You need to have an understanding of that and have it written, have a plan towards how do you get there. So the goal for today is really to help you understand the context around such a point and how do you plan to make sure you get that done. In the course of the next session, I'm going to be spending quite a bit of time talking about various investment vehicles that can achieve, help you achieve those goals. But today is really how do you set a goal? We will have some exercises, one or two, and then I will ask us to do some things as like take-home assignment. How much do you want to have? If you plan your resources well, you might be able to retire a little bit earlier. And when I use the word retire, I'm not talking about just sitting at home and doing nothing. I mean getting to a point in your life where you work because you want to, not because you have to. That's what the way I see the term retire. You work, because it keeps you busy. And most of what you're doing at that point in time is really value adding to you. It's to those around you. It's not for the paycheck that you're working. If you start early, you can get to that point earlier, and then you spend the rest of your life, just serving humanity, serving God. Of course, taking time out to do things. You have that freedom. You can keep doing what you're doing, no need to change it. But if you choose to reduce the time you're working, to reduce the kind of work you do, the freedom to be at that point is what anytime I say retire in the course of this session, that's what I mean. I'm not saying waiting till one day when you will no longer be working. That's not what I mean. When you get to that point where you don't have to work, but you work because you want to, that is someone that has gotten themselves to the point of retirement. Okay, so the question is, what do you need to do to get to that point? What do you need to do on a daily basis, weekly basis, however the frequency is, to get to that point? That's the kind of question we want to try and answer today. All right, so to answer that question, we're now getting into the meat of the training for today. We will be looking at numbers quite a bit in this training session. And if I'm going too fast, please feel free. In the course of this session, if you need to ask a question, please feel free to just raise up your hand. I should be able to see on the screen that your hand is raised, and I will ask you to ask your question. Don't feel like you're disturbing me by slowing the class down or asking us to clarify something. Please, the objective is that you learn out of this. I see there's a lifted hand. Damilola, you raised your hand. Do you have a question?
Yes. Will the recordings be made available after?
Yeah, I'll make it available. I've started the recording, but my preference is that you stay. But if you need to leave, that's fine. I know you have some things going on.
Mostly just so that I can watch it again. Yeah.
I'm listening. That's good. Too. Excellent. That way you can go back and listen to it. That's excellent. All right. So this is going to be our first exercise. Now we're diving into the meat of the training. All I said the first 10, 15 minutes or so is to just kind of help us to start thinking about, why am I even interested in a class like this? As a child of God, God expects me to use the mind He's given me to kind of plan, to think, and then walk towards those things, not, leave everything to God and not do anything about it. So how do we go about those things when it comes to the area of our finance? That is the goal. So that was all I first said. Now let's start talking about a few more specifics in this respect. All right, so you need to understand, assess, and understand where you're starting from towards where you want to get to. I talked about goals earlier on, having a plan and then working towards it. So the first thing in that respect is you want to understand your starting point, where you are today. The only way to really do this properly is to be honest, completely honest with ourselves and clarify these kind of things. So there are a few things I'd like to define. One is what is called net worth. Net worth is the difference between the things that you own, the value of them, and the things that you owe, the debts you have. The difference between those two is what is referred to as net worth. Net worth. And let me just correct something in that slide quickly. I noticed I had to, but I can fix that later. I just want to correct it now. So the first thing that you'll need to do will be to kind of make a list. And of course, I know that if I ask you to do all of that right now, you can't do it. So it's going to be an assignment. So this is assignment number 1, right? So the assignment is that I want each person participating today to kind of take a stock of your life in terms of what God has blessed you with. If you own a house, whether it's one that you live in, maybe you have a rental property, if you have some paper assets, stocks, funds, to 401k or company sponsored retirement plan. I'm going to be explaining the nuances of all of these different things. We won't get to that in today's class, but we will next class. What is the value, the current value of those things? If you own a vehicle, what is the value of it? If you have some kind of savings, what is the value of the savings? And then if you own a house, for example, maybe you paid, in this case of this example, you paid $185,000. The value of that house is $185,000. But you bought it at, let's say, $187,000, and you've paid it down to $185,000. So what you owe on that house currently is $185,000. That's a liability. Liability is what you owe or something that takes money out of your pocket. That is a liability. So make a list of those things. That is what this first assignment is. And then including credit cards, for example, if you owe some money on credit card, and this, I always tell people that, the witchcraft of the West is credit. It has trapped so many people, and it's creating problem for so many people, so many. I have the privilege, as many of you know, of being in the marriage counseling, in marriage ministry, I should say, and I've had an opportunity to counsel a lot of couples. That part of the reason they have challenges is because of the issue of their finances. And it stems to how easy it is to have access to credit in this part of the world. In some instances, they market credit to high school and young college students who really don't understand how credit works. And they take it thinking it's free money. I always tell people it's easier to spend on a credit card by nature. And it traps people down quickly. Anyway, I won't get into that as much today. So make a list of the things that you own. You want to have an understanding of that. And sum it all up. Make a list of the debts you have or the things you owe and sum it all up. The difference between the two in accounting terms is called your equity. In terms of personal finance, is referred to as net worth. But in financing, in accounting and finance generally, the difference between assets and liability is referred to as equity. So for the purpose of this class, we will stay with the term net worth because that's what is used when it comes to personal finance. So in this example, when you do yours, I'm not going to ask you to show me, but please do it. Find out what your net worth is today. The goal is to then say, okay, by the time I retire, this is where I want to be in terms of my net worth. We'll be walking through how do we walk through, get into that later. So that's one assignment. And then another assignment, again, because of time, we can't do that in the class, but I'm going to ask that you please take time out to do this by yourself, is to calculate what is called the burn rate. Your burn rate essentially is what you spend on basic needs, every month to cover your basic expenses. That is your burn rate. So it looks like somebody wants to join the class, so I just let them in. So that will cover all your normal expenses, right? What are those expenses? Let's say, as in the case of this example, that sums up to be $5,000 a month. And then you'll also calculate what they call your run rate. Essentially, your run rate is how many months do you have? If money is not coming in from, let's say, some kind of income from savings or your work or even investment, if nothing is coming in, the money that you have right now, your liquid asset, which in accounting terms they call current assets, right? Your current asset, money that you can access in the short term. Short term could mean different things to many different people, but money that you can access in case no other money is coming in. How much is that money? In this example, if you look at the things that I have listed above, if you have a house, you can't just turn that house into money today. even though you can sell a house and get money, you can't do so like immediately. So a house is not what they refer to as a current asset. In accounting term, is a fixed asset. It's a long-term asset. It's an asset that is not easily or readily turned into cash. Okay, so in this case, if you look at the things that I listed, the house, the stocks, the retirement account, even the car, maybe someone could say I could go sell a car, possibly. Really, the things that is truly a current asset or something that you can turn to money quickly is the savings, or it's already money in this case, at least based on this example. So if you divide that money, what you have as current asset by your bond rate, it gives you an idea of your run rate. That is how long, if you don't have money coming in, you have money on hand to spend. Having money is very important. It gives you freedom. So you want to have an understanding of what it is, how long that is. So in this example, the current asset is really only 10,000. And if that person spends 5,000 a month, that individual's run rate is only 2 months. This is where many people is, about 2 to 3 months is what it is. So that is an assignment. I'll share this page with us, some assignment to do individually. For those that have been in the class before, I'm sure you've done this. You don't need to do it again. Okay? Or you can just do it again for the sake of really refreshing where you are at. So that's the first step, understanding where you are at, right? Now I want to play a short audio clip, and I would like you to please just listen to it. Present something else. Okay. I'm going to play this audio and keep quiet for the next 10 minutes.
Perhaps your most important responsibility as an adult is to achieve financial independence for yourself and for your family. Aside from the practical, tangible benefits of having all the money you need, there are even more important reasons for obtaining financial freedom. Earlier in this program, we talked about the law of control, which simply says that you feel good about yourself to the degree to which you feel you are in control of your own life. There is perhaps no single factor that will rob you of a feeling of control more than feeling that you don't have enough money to pay your bills and to support your lifestyle. We said in the last session that the most...
Can you hear me? I want somebody to just say yes. I'm muted.
Yes.
Okay,
Yes.
Good. All right, I'll continue it then.
basic human need is for security, for freedom from fear of poverty, of want, of dependence, and of being destitute. The fear of poverty and the fear of failure associated with it causes more unhappiness and more underachievement than perhaps any other single factor. For both men and women in America today, single or married, the achievement of financial independence is the critical issue in whether or not they become everything they're capable of becoming. If a person is worried about money all the time, he never has a chance to enjoy the higher, finer things of life. We also know that financial independence, riches, begins with a state of mind. Becoming wealthy starts with a goal, accompanied by affirmations, visualization, and emotionalization, repeated over and over again until the goal is driven deep into your subconscious mind, where it then activates all the mental laws that we discussed in earlier sessions. Financial freedom is only possible when you accept complete responsibility for your financial condition, when you absolutely refuse to make excuses, rationalizations, or justifications for the situation that you find yourself in with regard to money. The acceptance of personal responsibility for everything that you accomplish comes before any meaningful and constructive change or improvement can take place. The inability to delay gratification is the #1 reason why people worry about money all their lives and then retire poor. The inability to refrain from spending everything you make and a little bit more besides will more than anything else guarantee that you end up worrying about money endlessly. The flip side of this equation is that the ability to delay gratification, the ability to withhold and refrain from spending in the short term, so that you can enjoy the feeling of pride, confidence, and self-esteem that goes with financial independence in the long term is the number one reason people achieve financial independence in America. The law of accumulation says that every great achievement in human life is an accumulation of hundreds, if not thousands, of little efforts and sacrifices that no one ever sees or appreciates. A great career is preceded by hundreds and thousands of hours of hard work and preparation to become excellent at what you do. Financial independence is preceded by small efforts of saving and sacrifice, repeated hundreds, perhaps thousands of times, with the knowledge that these efforts will eventually accumulate a large amount of money that will enable you to retire wealthy and never have to worry about money again. The law of attraction says that like attracts like. With regard to money, you've heard it said that it takes money to make money. The fact is that when you begin to put aside a little money, that money begins to radiate a magnetic energy that starts to attract more money to you. As long as your attitude towards your money is positive and respectful, you'll find yourself acquiring more and more of it. As you increase your savings and invest your positive emotions in them, you'll find more and more money attracted to you from a variety of unexpected sources. The key to remember is that the more you have, the stronger will be the magnetic force and the more will come to you. On the other hand, the less you have, and especially if you have none, the less magnetic force there is attracting money into your life, and you'll simply have money problems all the time. The starting point of achieving financial independence is for you to begin saving part of your income every single month. The basic rule for financial accumulation has always been pay yourself first. Each time you get your paycheck, take a certain amount off the top of your check and put it into an account for financial accumulation that you never touch, except for careful, conservative investment, as I'll talk about later. What most people do, which is invariably fatal to financial success, is that they only save what is left over after they've paid all of their bills and expenses during the month. But for you to achieve financial independence, you must pay your bills and expenses with what is left over after you've saved a minimum amount from each paycheck. Your minimum target amount for monthly savings is 10% of your net income. If your net income is $1,000 per month after all taxes and deductions, then you would place $100 into a financial accumulation or savings account each month before you began paying for other things. You must begin to train yourself to live on 90% of your net income. Now, what if you're in debt when you begin? What if you don't have enough money to last out the month as it is? Then, you must begin by saving whatever you can. With a little bit of effort, you can easily save 1 or 2% of your net income. You can live on the other 98 or 99%. As you become comfortable with living on 98%, you can increase your savings to 3 or 4% per month, and then later to 5 or 6% per month until you eventually get it up to 10% per month. In the meantime, you can begin to cut down on all unnecessary expenses and commit a minimum percentage of your income each month to reducing your indebtedness. Now you will have 2 accounts, one account for financial accumulation and one account for debt reduction. In a very short period of time, you'll become accustomed to living on 98% of your income, then 95%, then 90%, then eventually 85%, then 80%, and so on. Many years ago in Winnipeg, Canada, a gentleman came into my 2-day seminar at the end of the second day and wanted to ask me for my advice. He said that he wanted to make sure he was doing the right thing with his money. Even though I was tired and he hadn't attended the seminar, I invited him to tell me his story, and this is what he said. He told me that he only had an 8th grade education, and his wife had dropped out of high school in the 10th grade. He worked as a gardener in the summer, and he worked shoveling snow in the winter. His wife worked as a waitress in a cafe. They both earned just slightly above the minimum wage. He said they realized they didn't have a lot going for them, but they had heard that it was a good idea to save at least 10% of their income, so they began doing that every paycheck. After 6 months, they were able to increase it to 15%, and by the end of a year, they were saving 20% of their net income. This was when they were in their early 20s, a few years before. Doing this, their combined savings began to add up. Once they'd accumulated about $2,000, they found an opportunity to buy an older house that they could fix up and rent out. They were living in the basement of the home of his in-laws when they bought this house, and when they'd completed the purchase, they moved into the house and worked evenings and weekends renovating and painting. When it was fixed up, they rented it out for a little bit more than the mortgage payment, giving them a positive cash flow on the house of about $50 per month. Over the next 7 or 8 years, they repeated this process, saving their money until they had enough for a down payment, then combining it with the positive cash flow that they were getting from their accumulating number of houses, and then making down payments on new houses. He said that he was now 32 years old and his wife was 30. They had 12 houses, 3 duplexes, 1 triplex, 1 fourplex, and 1 small 12-unit apartment building. They had an equity of more than $500,000 that had built up over the previous 10 years, and they had a positive cash flow of more than $3,000 a month from their various rentals. He said that he just wanted to check with me and ask me if he was doing the right thing with his resources. I assured him that he was definitely doing the right thing. He said that in another 8 or 10 years they would have a net worth of more than $1 million. Not bad for 2 people who never finished high school and who still worked at minimum wage jobs. The point that I'm making is that the starting point of their success was when they began to save a certain percentage of their income each month. W. Clement Stone put it very well when he wrote, "If you cannot save money, then the seeds of greatness are not in you." Your blueprint for financial independence begins with your disciplining yourself to live on less than you earn, and eventually to live on a good deal less than you earn. The major psychological benefit of saving money is that it gives you a tremendous feeling of pride, self-respect, and self-esteem. A person who has money in the bank and money in his or her pocket is a very different person from the person who has no savings and who is totally preoccupied with money worries most of the time. In order to become wealthy, you must fight against the almost irresistible power of what has come to be called Parkinson's Law. Parkinson's Law says that expenditures always rise to meet income. This law says that no matter how much you earn, your cost of living tends to rise to absorb every single penny. If your income goes from $1,000 per month to $3,000 per month over a 2 or 3 or 5 year period, if you're not extremely well disciplined, you'll find that your cost of living will rise to the same level and will absorb everything that you're making. Dr. Thomas Stanley of the University of Georgia, who studied many thousands of affluent Americans, concluded that there are 2 types of people with regard to money. There are those who look like they have a lot of money, and then there are those who really do have a lot of money. His studies concluded that the people who seem to be doing extremely well, driving flashy cars, taking expensive vacations, buying lots of expensive clothes, are usually living just 1 paycheck ahead of the bill collectors. He said that the really wealthy people in America and most self-made millionaires live on ordinary streets and drive ordinary cars and live very ordinary lifestyles. Perhaps the finest example of this was Sam Walton of Walmart stores, the richest man in America. When he was worth $8.7 billion in 1988, Sam Walton was still driving to work in a pickup truck. Many wealthy men and women drive ordinary cars, even station wagons and vans, because most of their money is busy working for them somewhere else. Many people who look wealthy have all their money invested in symbols of wealth, which are losing value every single day. Now, the 3 legs of the financial planning stool are savings, insurance, and investments. With regard to savings, your philosophy should be to build what is called a financial fortress. A financial fortress is an amount of money that protects you from the unexpected ups and downs of a dynamic economy. Your minimum goal for savings should be to have between 2 and 6 months' living expenses put aside in a fairly liquid form, such as savings accounts, money market accounts, or a money market mutual fund. When you've reached the point where you have built your financial fortress, when you've got enough so that you can live for 2 to 6 months without worrying about money, you'll have become a totally different person. You will have an aura of unshakable self-confidence and self-assurance that other people will notice immediately. You'll not have to put up with a job or a boss that you don't like, nor will you have to stay working at something simply because you can't afford to quit. You'll be able to choose to do what is best for you. You'll be able to choose the kind of work you want to do and the kind of people you want to work with. You'll be able to choose only to do what you love to do and care about, rather than being forced to do something that has no meaning for you aside from the paycheck. The second part of financial planning is life insurance. The only kind of life insurance that you should buy, and you should only buy life insurance if you are a man or a woman with a family to provide for, is term insurance. Term insurance is much cheaper than any other kind. You can buy it in almost any amount, and it will pay out the face amount of the policy to your estate or to your family should you die unexpectedly. When you become wealthy and you have an estate that you need to protect from estate duties upon your death, that's the time for you to begin to think about permanent insurance, which is insurance that has an equity or cash buildup contained in the premium and which can never be canceled for any reason. But for the time being, until you have a lot of money that you need to protect from the tax collector, you should only buy term insurance, and only if you have a family to support. You should buy enough term insurance so that the proceeds from the insurance will enable your family to maintain its standard of living at the current level. If your current income is $25,000 per year, and your family could earn 10% per annum off the proceeds from a life insurance policy, you should have $250,000 worth of term insurance, payable to your spouse as your beneficiary. In the event of your death, this amount would go directly to your spouse, and since it's below the taxable limits, it would go tax-free as part of your estate. The third leg of the financial planning stool is investment. Investments are what will eventually make you wealthy, and it's absolutely essential that you become as wise as a serpent and as clever as a fox with regard to how you invest your money. The first investment that you should take maximum advantage of is a self-directed, tax-sheltered investment such as an IRA, a Keogh plan, or if possible, a company pension plan. Even though the amount that you can put into an IRA or a Keogh plan is limited, as would be a company pension plan, you should take advantage of these plans and invest every single possible cent that you're allowed to put into them. Money that accumulates in a tax-sheltered plan can grow at a rate of 50 to 100% faster than money that's invested outside of such a plan and which is subject to taxation on every dollar. Your earnings in the form of interest and dividends are fully taxable when they're received by you if they are outside of an IRA or Keogh plan. The earnings inside an IRA or Keogh plan are tax-deferred. That is, they continue to grow and compound without taxes until you actually take them out of the plan when you retire later on in life. Once you've taken maximum advantage of tax-sheltered investments, there are three other types of investments that you should think about. The first is a money market fund. A money market fund is different from a money market account at your bank in that it is invested more aggressively and it pays a higher rate of interest. Money market funds can be opened for as little as $500, and they're available from almost all financial planning organizations. It's very important when you put your money into a money market fund that you read its prospectus and that you make sure that the costs of administration of the fund are no more than 1/2 or 3/4 of 1% per year. If they're in excess of that amount in total, you should seek another fund. The time to invest in money market funds is when interest rates or the stock market seem to be unstable and unpredictable. The ideal time to invest in a money market fund is when interest rates are rising, and especially if the prime rate has risen above 9.5 or 9.75%. The prime rate is the lending rate most major banks charge their creditworthy customers. That's the time when you will get your highest and safest return on your savings in a money market fund. The second investment that you can use is a mutual fund. The only kind of mutual fund for you to consider is a no-load mutual fund. A no-load mutual fund is one that charges you no commissions for investing. 100% of the amount that you put in goes to work for you immediately. There's very little difference in the financial performance and rate of growth between a no-load mutual fund and a full-load mutual fund. A full-load mutual fund will charge you as much as 8.5 or 9% commission for the privilege of investing your hard-earned money. That money will be paid to the person who has sold you the investment. It will not be deposited to your account, nor will it be available to you ever again. Your investment will have to grow by 8.5 to 9% just to enable you to get back to even if you pay this kind of a commission when you buy a mutual fund. There are several organizations that offer no-load mutual funds. You can find advertisements for them in the newspaper, in Money Magazine, in mutual fund guides, and you can ask around and get advice from other people you know who are using them. The first rule of investment is always to investigate before you invest. The only thing that is easy about money is losing it. Making money requires patience, fortitude, and never-ending vigilance, even in mutual funds. The time to invest in a stock-based mutual fund is when the prime interest rate is declining or when it's below 9.5%. The rise and fall of the prime rate correlates very closely with economic expansion and recession, with booms and busts in the stock market. When interest rates are low, the cost of capital is low, and therefore businesses rush to invest and increase their productive capacity and their profits. When interest rates are high, companies cut back on expansion plans. They maintain or cut back on their numbers of workers, and they decrease the amount of economic activity or opportunities that they take advantage of. A mutual fund is a fund invested in by thousands of individual investors such as yourself. This pool of funds is then invested in a broad cross-section of stocks traded on the major stock markets of the United States or other countries. A mutual fund is managed by professional money managers, people who watch the market 40, 50, and 60 hours per week. These financial professionals have available to them enormous quantities of information that individual investors simply could not acquire or have access to. When a mutual fund invests in a broad selection of stocks, your risk is also spread over a broad selection of stocks. Many well-managed mutual funds increase in value greatly in excess of the general market. When the market slumps, as it did in October 1987, most mutual funds do not decline as much as the overall market averages, or as do individual stocks. A no-load mutual fund professionally managed in a broad assortment of carefully selected stocks is one of the best investments for financial growth when the prime rate is below 9.5% and declining. The third type of investment available to you for financial accumulation, once you have your 2 to 6 months' worth of savings put aside, is bond mutual funds, also no load. The best time to invest in a bond fund is when all indications are that interest rates have peaked and are declining. As interest rates decline from their recent highs, the value of the individual shares in the bond fund increases. Since the bond funds are composed of securities bearing fixed rates of return, as the average interest rate in the marketplace declines, the return on these bonds, relatively speaking, goes up. Let me explain. Let's say that you buy a single bond with a $1,000 face value and it pays 10% interest per annum. Your return will be $100 per annum, or a return on investment of 10%. Now let's say that the prime interest rate drops to 8%. 8% now becomes the multiple at which people will buy bonds. New bonds will be issued at 8%, and outstanding bonds that are paying 10% will increase in value to about $1,200 per $1,000 of face amount. By paying $1,200 for the bond, the return to the investor will be 8%. This is why you always buy bonds when market interest rates are declining. Every point of decline in the prime rate increases the value of the bond fund by as much as 10%. To summarize then, the very best investment vehicle for financial accumulation for the average person is a no-load mutual fund, either a stock fund, or a bond fund, or a money market fund. What is the best single investment? Well, there's no answer to this question. At one point in the economy, one investment will be better than all others. As the economy and interest rates change, another investment will be better. You must watch your investments carefully, and you must take 100% responsibility for every decision you make with regard to how you allocate your investment funds. No one else can make your investment decisions for you. One of the most successful businessmen in America was once asked about the philosophy he had that had enabled him to acquire so many companies and so much money. He said that he had just 2 rules. Rule number 1, he said, was, don't lose money. Rule number 2 was, he said, whenever you are tempted, refer back to rule number 1. A Japanese proverb says that making money is like digging sand with a pin, whereas losing money is like pouring water into the sand. Money is hard to earn and easy to lose. If all you did throughout the course of your working lifetime was to save 10% or more of your income and put it away and let it accumulate at interest, that alone would make you financially independent. When you lose money for any reason, you are also losing the number of months and years that it took you to accumulate that money. You're actually losing a part of your life, the amount of your life that you had to exchange for the amount of money that you lost. Whenever someone reaches the point where he or she feels that he or she can afford to lose a little money in an investment, you can be sure of one thing. That person is going to lose not only a little, but probably a lot of money. Your attitude must always be, don't lose money. All serious money in the United States is conservative money. It is what economists call risk-averse money. Serious people with serious money continually seek for ways to increase their money by minimizing risk, not by seeking for risk. Successful entrepreneurs and business people are not risk takers. The successful ones are risk avoiders. That's how they became successful. A basic rule for investment is to spend at least as much time investigating an investment as you spend earning the money that you're prepared to invest. There is nothing that takes the place of research. Many financial advisors who are selling various investments are not particularly well off themselves, and in addition, they often know very little about what they're recommending. Your attitude toward financial accumulation should be that when you put the money aside, you never spend it, not for any reason. You don't put the money aside for a rainy day. You don't save up so that you can buy a motorhome or a boat. You set up different financial accumulation accounts for those things. Your savings and investment funds are put away never to be touched, to grow and multiply over the course of the years until they yield you the financial independence you desire. The very best way to make money, and then make even more money, is to keep on doing the same thing that you're doing and to do it extremely well. You must develop a lifelong philosophy of holding on to your money carefully once you've earned it. And here's another part of your financial fortress planning. Wealthy men and women in America have low debt or no debt. The only kind of debt that they allow is debt for investments into assets that are paying back more than the cost of money they've borrowed. The only kind of real estate they own is real estate where mortgages and all expenses are serviced by the rent that comes from the real estate. The only time they borrow to invest in their companies is when they can earn a higher rate of return in their companies than they have to pay for the money in the first place. As a general philosophy, one of the wisest things that you can do if you want to enjoy peace of mind and become financially independent is to make a plan, starting today, to pay off all your debts and to live debt-free, aside from your home mortgage and perhaps your car. As a general rule, you should never borrow for your expenses of consumption, for food, rent, transportation, clothes, and other things that you use up on a monthly and yearly basis. You should lease or rent assets that depreciate or lose value, and should only borrow to invest in assets that go up in value as time passes, in excess of the cost of the money or the interest rate. You have 3 periods in your life with regard to money. The first 25 years are called your learning years. During this time, you acquire your basic education and your basic ability to earn money. The next 40 years are called your earning years. These are the years where you work the hardest and increase your income the most. The last 20 years are called your yearning years. These are the years when you look forward to retirement, either a comfortable retirement or a retirement accompanied by financial problems and worries. It's helpful for you to know that most people make the greatest amount of money in their lives after the age of 45. It's only after this age that your expenses for raising your family begin to diminish and you're being paid the highest amounts that you've ever earned. It's during this time that you can begin to save 20 and 30 and even 40% of your income to run up your savings and investment accounts to their maximum prior to your age of retirement. Nonetheless, even if you are in your late teens or early 20s, for the sake of your character, your peace of mind, and for your future, you must begin to save and put money aside. People who say silly things such as, "I'm not here for a long time, I'm here for a good time," are people who have a failure attitude and who will surely be in serious financial trouble before their careers are over. Wealth in America can be defined as simply cash flow from other sources. You're only wealthy to the degree to which you do not have to go to work each day in order to support your current standard of living. Wealthy people are those who can stop working with no interruption in their lifestyles. Your primary job during your financial accumulation years is to build up a portfolio of assets that yield you an income which is eventually greater than the income that you earn from working. At that point, you can stop working if you desire and begin to spend more of your time managing your investments. Here are a couple of important points with regard to money. First, there is no such thing as easy money. The hardest money that you will ever get will initially look like easy money. And second, there are no investments without uncertainty. There's a certain amount of risk in everything that you do in life. Your job is to minimize the risk wherever possible. Never invest in gold, silver, or precious metals. The worst of all investments over the last 25 years has been gold. Gold gives you no rate of return. It is inert. There are many people who make a lot of money by selling gold, silver, and precious metals, but the people who purchase them very seldom make anything. In addition, never purchase an investment over the phone unless it's from a known and respected company. The United States today is full of confidence games and scams being sold over the phone to unsuspecting investors. These people often work out of motels and bucket shops, and they move from place to place as fast as the police become aware of them. Their favorite swindles are in commodities, precious metals, and penny stocks. If someone calls you to offer any one of these, hang up so fast that it makes their ears burn. I have met so many people who've lost so much money and so many years of hard work to these swindles that it almost breaks my heart. Don't you be one of them. Also, don't invest in antiques, Persian carpets, coins, or stamps unless you're a full-time expert in those fields. There are as many of those investments decreasing in value as there are increasing on any given day. Fully 90% of all original artworks, paintings, sculptures, and so on of any kind never sees its original retail sales price again. From the time you purchase it, it declines in value, usually by 80% or more. These are not good investments for a person who is serious about becoming rich. These are only things that you buy when you're already wealthy, and then you buy them for their beauty and for the pleasure that they give you, but not as an investment. Don't invest in oil and gas or mining stocks, and don't invest in commodities, even with reputable commodity dealers. Commodities are the most dangerous and the most volatile of all investments, and virtually everyone who invests in commodities for any period of time loses almost everything that they put in. Your goal must be to achieve financial independence as rapidly as you can. This must be your driving force with regard to money. You must assiduously avoid the pleasure of short-term consumption in exchange for long-term financial security. You must discipline yourself to begin and maintain a regular savings program from now right through to the end of your life. You must train your children and members of your family in this discipline so that they very early develop the mental mindset that leads to financial success. Now here's an exercise for you. Sit down and write out a plan for financial accumulation and a series of milestones or goals for 1 year, 2 years, 3 years.
Okay. I'll stop at that point. Let me just open it up, see if anyone has any question on what I just shared with us on that audio video before we kind of continue. I think you can still, I'll just stop the audio presentation. And then we just have the PowerPoint. I think you can still see my PowerPoint. Let me just be sure of that. Can you still see my PowerPoint?
No, it's not there right now.
All right, thank you. How about now?
Yes.
Excellent, thank you. All right, let me open it up. Let's take a few questions. If anyone has any question. Now, the teacher there, the speaker there, Brian Tracy, is the time he made this video, this book, it's from one of his audio books called Personal Action Strategies for Personal Achievement. It's based on some of what he's saying, was like in the 80s, 90s, maybe early 2000s. So some of the numbers he quoted, like the interest rate and stuff like that, it's not valid for today. Some of the things are not specific, but overall, 80, 90% principle-wise are correct. So don't get hung up on some of the numbers that he used as interest rates and stuff like that. So does anyone have any question before I continue with some of the other things I want to kind of cover. A few key points that he made, that I'd like to kind of talk about. He mentioned three things. I hope you wrote those down, that are legs on the stool of financial independence. Is there anyone that can tell us or remembers what the three things are? Three things.
Saving, investment, and insurance.
Thank you. Savings, investment, and insurance. And then, I have it on this screen. So thank you. So saving, it spoke quite a lot about the need to save. And as a child of God, I believe we are tithing. So after you've taken out your tithe, I'm talking about what is left after that. You should be saving. He's based on his thoughts, 10%. And he also advised that should increase over time. Anyway, it causes 3 rungs on the ladder of financial success, or 3 legs of the stool, or something like that. So saving is really where it starts. Now we'll talk about how do you get this. A lot of people find it difficult to save, but part of this training is to help us really think through how can we be successful saving. He talked about life insurance, and he explained term insurance as well as permanent insurance. And then he talked about investment. He said this is really what makes you wealthy. In the course of this class, this training, we're going to talk about the various, that is really the meat of this training, really, to a large extent. But you can't even get there unless you know how to get there, right? So I'm going to be explaining the nuances or the differences, what you should be doing, what you shouldn't be doing. I will explain all of that. Each person's situation is different, but to a large extent, we all can do certain things very, very well. So anyway, he explained those kind of things. Now let's go to the next slide. I really want to delve into in the course of the next few minutes. This will form the framework for this training session. These 6 steps financial planning process. The first step is what I've given us as an assignment. It's really understanding where you are at today. Your run rate, your burn rate, your net worth, and I've explained that. That will be an assignment that I will share on the group. I will share that assignment. I'll share that slide to kind of remind us on how to do all of those. So I'll send that out after the training. One key point is run rate is an indicator of wealth, if you want to say so. He said something. He said, don't spend your money on symbols of wealth. I like that quite a bit. Many people spend their money on symbols of wealth. I used to have a professor, when I went to business school. He said he drove through the parking lot one day and came to class and said, all of you are driving your future. And that really got me thinking. He said he went to the parking lot and all he saw there were big cars, that we were all in the early stages of our career. What do we need those kind of cars for, and all of that? But anyways, that is what is costing some people the opportunity to invest. The need to impress others, the need to live above their means and things like that. And I said this earlier on, that it's never about how much you want. Maybe I've not said this. It's really about how much you keep and how hard what you keep is working for you. We need to learn to grow our assets and keep our liabilities controlled. See, if you've read the book, Rich Dad, Poor Dad, it's not one of those that I've shared on our platform in the last few weeks, but I want to encourage you, if you haven't read that book, to really read it. There are 2 more books that I will ask us to find time to either read or listen to. One of it is Rich Dad, Poor Dad. And the other one is one small book called The Richest Man in Babylon. Very small book, but very powerful. And I also tell people, if you can't read, because I know we're all very busy, please just buy the audio book. I do more of audio book today than real paper, book. So buy the audio book and listen. Your mind is hearing those things and you can still use it. So in that book, Rich Dad Poor Dad, Robert Kiyosaki used this cash flow, these symbols, or these drawings, to explain the cash flow pattern of the rich and the poor and the middle class. So an income statement, companies use this term a lot, or accountants and accounting, these terms are, but it's very practical, very important that if you want to be financially successful, you begin to understand financial languages. One of the things that a lot of these people that cheat people do is that they use terms that they know that you don't understand, and they kind of cheat people. I was speaking with someone recently, and he talked about the fact that debt consolidation has cost him a lot of money. It's unfortunate when they are talking to you about this, because what that means is, or let's say you owe 5,000 on 3 credit cards and you're paying 10% on each one. Now you owe 15,000 on 3 credit cards. Bring all of those cards to us. So you only owe 15,000, and then we'll give it to you at 8%. It's one of the worst things anyone can do to you if you don't understand what they are trying to do. Because now you have locked in or prevented your ability to pay that off faster, because you now have a bigger debt. And usually most of those people, they will take their interest first before they even start taking care of your principal. So it's not a good thing to use. But the point is, if you don't understand financial terminologies, they will eat your lunch any day. So the first thing I want you to kind of think about when it comes to financial terminology is what they call income statement. An income statement is just as the name implies. It shows your income, everything that comes to you monthly, quarterly, annually, and everything that you spend money on. That is your expenses. Pretty simple. Your balance sheet shows the things you own, like I was showing us earlier on, and the things you owe. And I explained to us that the difference between assets and liabilities in accounting terms is called equity. But for the purpose of personal finance, it refers to as net worth. And he said, this is the cash flow of an asset. An asset is anything that puts money into the income portion of your income statement. That is, even if you don't do anything, if you own an asset, it will produce income for you. A liability, on the other hand, will always result in expenses. That's it, it will take money out of your income statement. It will always result in expense. And the sad thing is, what many people buy, as Robert Kiyosaki was explaining in that book, is liabilities. And then he then said, this is the cash flow pattern of a poor person. A poor person has, let's say, a job that produces an income, maybe from the form of a salary, or in some cases, what's it called, commission, and it flows out of his hand through expenses like taxes, rent, food, transport, clothes, and so on and so forth. Nothing of that income goes into the balance sheet side as an asset. So that person will never become rich. He will always be poor. And the question might be, well, it depends on what you're earning. That's a different conversation entirely, and we can get to that in the course of this training. So this is the cash flow pattern of a middle class person. A middle class person, just like the poor, he explained in that book, also has an income. Let me switch on the light, please. Just give me a second. Also has an income, but unfortunately, is not too. They usually have a big income, so they are able to buy things. All their money does not just go out as expenses. So they buy liabilities, which they think, or they are convinced by those that loan them money, that those things are assets. Mortgage is not an asset. It is an asset to the banker. I don't know if you've listened to these bankers, they will tell you that your house is not an asset. It's not, because it's as a mortgage. It is an asset to them, but it's not an asset to you, because it's going to cost you. You have to pay the mortgage. You have to pay taxes on it. You have to maintain the house. So your house, in a sense, is not an asset. It could be an asset when you sell it, if there's a difference between your buy price and your sell price. or there's been some kind of appreciation in value, then at that point it becomes an asset. But while it's there, it's really a liability because it's taking money out of your pocket. But to them, in their accounting books, it's an asset because the money you pay them is an income to them. So you can imagine for the bank's balance sheet, your house would be here because it will put money into their income statement, as it shows on this leftmost chart. But for you, it's really like this second chart. It takes money out of you. So anyway, for the middle class, all the income they use to buy liability. They buy big cars, they buy clothes on credit, they have student loans, and all of those are costing them money. And he explained those are not assets, as it were, because it's costing you through taxes, through mortgage, card notes, credit card, and all of those kind of payments. And then he said, this is the cash flow of the rich. A rich person he could still have a job, without a doubt, but he has understood how to turn the income from the job into assets. Those assets now are producing income. So it might be real estate, it might be some paper investments, intellectual property. They're producing income in form of rental, dividend, capital gain, interest, and stuff like that. They still have the expenses, but if you listen very well to the teacher that just spoke, when you become wealthy is when the income produced from your assets exceeds your burn rate. I've explained what burn rate to us, so minimum monthly expenses. That's then you become financially independent. You don't have to go to work because the money you need is being produced, from your assets. That's where we all want to be. That's my prayer and my desire for every one of us in this class, that you understand what we're talking to the point that you grow your asset column in the balance sheet to the point that they're making income above your burn rate. All right, that's the first step. The next step, which will lead to some of the exercises we will do, and I will give us as an assignment, is now defining your goals. Now that you know where you are at, the next question is, where do you want to go? We've talked about their motivation and all of that earlier on. So the question is, how do you do this? This is where I want to kind of spend a little bit of time on how do you do this. But before I do so, I want to explain the concept of the time value of money. I have some new participants in the class. So for those that have been in the class before, please pardon me for having to kind of go through this again. It's okay that you're listening to it might reinforce what you have learned, but I have some people that are in this class for the first time. So I'll take a few minutes to quickly go through it. $1 today is worth less than $1 tomorrow. I think everybody understands that almost intuitively, especially when you come from a place where the inflation rate is very high. In fact, lately I was in the shop recently, and one woman was just complaining about the cost of a carton. I think it was a carton of egg or a loaf of bread or something like that. Saying she used to buy it for $3 and now it's $6. I just smiled gently in my mind. That is what inflation does. Let me ask us a question. Something very important happened in the economy, the US economy. In fact, the global economy this week. It happened in the US. Does anybody know what it is? It has to do with interest rate. Does anybody know what it is? Now, the reason I threw that as a question is I want us to begin to be more attuned to financial things. During the course of this week on Wednesday, the Fed...
The interest rate.
Yeah.
The Fed reducing interest rate.
Yeah, the interest rate came down a little bit.
Which interest rate came down? You are right, but I want you to just explain a little bit. Do you know what that interest rate that came down, what it was?
The central bank interest rate?
Okay, thank you. It's called the Fed interest rate. Do you know what that interest rate is? Does anybody know what that interest rate? If you've been in this class before, you should be able to. I think I've explained it before. What is that Fed interest rate that was lowered?
The cost of borrowing money by the US government, I think.
Okay, you are along the right line. It's actually the cost of borrowing money from the the central bank, if you want to say it that way. There's a lot that goes. I asked us to kind of listen to watch a video in the course of the last few days called "The Way the how the economic machine works," something along that line. Please, if you haven't watched that, it's like an animation for 30 minutes. Please watch it. It's very, very rich. There's what they call macroeconomics, right? Which is the economics at the national level or global level. Now, there are things that are going on in the house of people that affects things on the global scale. Banks have to borrow money from banks. There's an amount they're expected to have, but people are taking their money and all of that on an ongoing basis. So the rate, if I need money and I need to borrow from another bank, that rate that was announced on Wednesday, which is now between 4 and 4.25%, is the rate at which the bank borrow each other money, which is also the rate at which they borrow from, like the central bank. That is critical because it defines the rate at which they will loan money to the people. In fact, it has not affected the interest rate in the market right now, because that will be a lagging effect. So that has not gone down. What they announced on that day is not the rate you and I can go and borrow money from the bank. No, it's the rate at which the bank borrow money from each other, banks. Okay, that rate, the reason that rate is important is because it is the lever with which the government tries to control inflation. Inflation is the natural consequence of the kind of credit society that we all live in. And what it does is that it lowers the value of money over time. That is why if inflation is too high, for those of us that are from Nigeria, I think most of us on the line are from Nigeria. The inflation in Nigeria, I think, is around maybe 15% or 18%. So that means if I buy bread for 100 naira today, by a year from today, I will buy it for 118 naira, something like that. Then the following year, it will be 136 or 140 something naira because the principal has grown. So the value of $1 today is worth less than $1 tomorrow, or a year from now, or 5 years from now, or 10 years from now. Money loses value because of inflation. And what the Fed tries to do so that inflation doesn't, so what happened was during COVID, the government of Biden, they lowered that rate to almost zero. That was why at the time, if you're buying a house, you pay like 2-3% if you have a very good credit, because the prime rate, the lending rate between banks is so low, they charge you just a premium of 2 to 3% depending on your credit, maybe up to 4% depending on your credit. But today, if you want to buy a house, it will be 6-7% or something like that, because right now the prime rate is now 4%. So I will put 2 to 3% on that. It's already 6 to 7%. So when they see that inflation is going too high, they raise that prime rates so that it makes it more costly to borrow money from the bank and reduce the amount of money in circulation. When the amount of money in circulation is reduced, people are forced to, even though they need something, they can't buy it. So it puts a downward pressure on the price of things, reducing inflation. That's what they're trying to do. So what happened when Biden's administration lowered the prime rate to the point that everybody had access to money, people were buying things, and then the Fed came in and they started raising that prime rate, that Fed rate. And what that resulted into is, it has stemmed inflation. You may not feel it yet, but it's beginning to reduce the rate of inflation. So anyway, I just wanted to kind of explain why they do that. Why are they changing that rate? It's just to control inflation. And when the economy is depressed, and they want some more money to come in, that is what that video was explaining. So please watch it. That's the way how the economic machine works. So anyway, this explains, some very, very key principle. PV is present value, V is future value. If I just say I have a principal of I, just use kind of investing to explain it. If the interest rate is I, if I put that money and I invest it for 1 year, so interest rate is normally quoted on an annual basis. My principal was P. So if I invest that principal, it will earn interest rate times the principal at the end cumulatively of the year. So I times P. You can then simplify that, this is simple algebra, and it becomes P into 1 plus I. So that's what I have at the end of 1 year. At the end of year 2, my principal is now P into 1 plus I, because that's where I'm starting. So my interest for the next year will now be that same I multiplied by my new principal. And then you can simplify that using algebra again, and it becomes P plus 1 plus I into 1 plus I twice, or 1 plus I raised to the power of 2. And that can be expanded to the nth number of years. And that becomes, at the year end now, the value of your original money is P into 1 plus I to the power of n. This is what makes compound interest work. It's an exponential function, So the future value of any amount is the present value multiplied by 1 plus the interest rate to the power of n. And you can then, if you know an amount in future, you can bring it to today's value by doing this simple math. You divide both sides by 1 plus I. So present value is future value by 1 plus I to the power of n. In this case, what you're doing is you're doing what they call discounting. You're bringing future value back into today's value. Okay. So just a simple illustration to help us appreciate, the time value of money here. Let's do an exercise. So if you take that calculation that I showed you, and I ask in this exercise, what is the value of $61 invested today at an interest rate of 5% in 10 years? If you take it into that formula that I showed you, it's actually it's $100. I'm showing the other side of it, the second question right now. So if you put your P is now 61.39, and then multiplied by 1 plus I, which is 5%, 0.05 to the power of 10, it's going to give you 100. The answer is 100. I'm telling you the answer. You can do that mathematics yourself. That means 100 naira in 10 years from today is the same thing as $61.39 today. So if I put $61 into an account and 39, earning 5% at 10 years, it becomes $100. But the flip side of it is also true. That means what I'm buying today for $61, if the inflation rate is 5%, I will need the $100 to buy it in 10 years. This is simple illustration. I would need $100 to buy the same thing in 10 years. So it's a bad thing to keep cash. It's one of the worst things. I tell people this all the time. One of the worst things you can do to money is to keep cash. And I don't know, so a lot of people struggle with getting that concept. They want to keep cash. But cash is eaten up by inflation, so that even though it's $61 today, in that 10 years, it's not $61 anymore. It's probably $40 or something in terms of what it can buy. And that leads to the term of real versus nominal value of money. The nominal value is the face value. The real value is what the thing can actually buy. I see somebody raised your hand. I'm not sure who it is that raised your hand. If you raised your hand, please go ahead and open your mic and ask your question.
Thank you, sir. The question I have is, if it's a bad idea to keep cash, then how should we keep emergency fund?
Okay, so we're going to get to that. That's part of this class. And I'm going to explain quite a number of things. But to quickly answer your question, you keep it in the money market. You keep it in the money market. In the current environment, even savings will give you about 4%, which is about the inflation rate in the US. So you can keep it don't keep it in a savings account that is earning less than the inflation rate. So you need to have your money in, if it's, if again, we're talking about savings now, in a interest-bearing account that matches at the minimum the inflation rate. So that is the answer to that question. Now we're going to look at a number of those investment vehicles in the course of the training. But if you keep it in cash, that is in a checking account particularly, or in a low interest savings account, it's almost as good as cash. We're not doing the right thing. Does that answer your question?
Yes, sir.
Yes. So it's the worst thing we can do to money is to keep cash. It's like we're throwing money away when we do so. All right. So there's nominal value, which is the face value, and the real value is what that thing can truly buy. So $100 in 10 years from today is how much if the inflation rate is 5%, and this is kind of the reverse of the same question that I just asked. It's really just $61 today. So if I can buy an item for $61 today, 10 years from today, the same item will cost me $100. Now, this is a very simple illustration of this, but it's about what it is. In the same last 10 years. And I will show you a model that you can use to kind of do this in a minute. A question. Should you invest $61.39 in an investment yielding 5% returns if the inflation rate is 5%? That's the question for the class. And if you've been in the class before, you should be able to answer this question. What's the answer to that question? And it's actually along the lines of what I just answered, what Dr. Dejimo just asked us. Should you invest $61 in an investment yielding 5% if the inflation rate is 5%? Anyone?
Yes.
Go ahead.
I got shy there. I think you said if it matches the inflation. You know what? I'm gonna let the other person go ahead. Go ahead.
Somebody else want to say something?
I can help answer. I think I heard the math correctly. That should be higher than the inflation rate. So 5 and 5% are the same. So you should not do that. I just look for 6 or 7%.
Thank you. And the key word to this question, that was a trick question, is the word investment. Is the word investment. Your return should be above the inflation rate. If not, you're just keeping pace. You're just keeping pace. Now, if it's your savings, the money that you want to be able to access in the event that something, goes wrong, wherever, that's a different case. But I'm talking about investment. Your return should be above inflation rate. Thank you. Destiny answered the question very well. So should you invest? If you don't know anything to do and that's the best you can do, fine. But you should look for investment that yield above the inflation rate is the answer to that question. Now, if you keep $61 in your piggy bank, how much will it be worth in today's dollar in 10 years? Somebody can do that calculation, but in the interest of time, I'll reveal it to you. Actually, I don't have it here, but it's just, I think it's around $40 or something like that. You just convert that using this same formula, whereas the 100 will now be 61.9, and then I didn't put interest rate here, but if you assume the same 5%, you're going to find that it's around $40 if you do that mathematics. So if I keep that $61 in the piggy bank, it's actually worth just a little more than $40 in 10 years. All right. I'm going to kind of show you one thing. Again, why am I showing us all of this? It's really to help us to think through how do I then come up with an understanding of what I want to have in the future. And this, what I'm going to show you right now, is such a powerful model. I was sharing it with someone recently, and they were really like, is this true? Is this true? Brethren, It is so true. Let me share. You're still seeing mine. Let me stop sharing and share something else. You should see an Excel sheet coming through. Can you see it? I think you can. Correct?
Yeah, we can see it.
All right. All right. This is, such a powerful model. Put this together a couple of years ago as I kind of understood and began to learn some of these things. I put it together and it's still absolutely true. And I mean, if you look at some of the numbers here, it will blow your mind. This is the power of just investing $200 a month is what I have here on this sheet. Just $200 a month times 12 is $2,400 a year. If you do that continuously and you put it into, investment that returns kind of on average continuously of around 10%. The numbers that you see here is what the value of that money would be, the future value that I just explained. You can see the formula here is the FV formula. The future value of that amount at the number of years that I have on column A. So if the rate of return is 10%, and this is not on, an unachievable rate. This is about the rate you achieve by investing in the market generally, and we'll talk about that as we go on. Between 10 and 12% is very, very doable. Historically, it's what the market has returned. But I just want to show you something. Look at this number here. This is 200. Let's assume you can get 20%. You can't really get 20% consistently for 60 years. You can't. But I just want to show you what the potential is. Look at the potential. It's almost $1 billion. Two-thirds of $1 billion, $200 is two-thirds of $1 billion. How is that possible? It is possible. It's called compound interest or compounding. What I was showing you in that mathematics earlier on. When time takes over, it takes on a life of its own. I asked you to watch a video. I think it was yesterday. I sent it to the group. If you haven't watched it, please go and watch it. He was talking about compound interest also. Albert Einstein said this is I think he called it the eighth wonder of the world. It's amazing how it works. The sad thing is that for most of us, it works against us because we allowed ourselves to be charged this rate. In fact, there are people that have credit cards that charge you 18%, 20-something percent. What happens is that it starts working against you. Exactly what I'm showing here starts working against you. Where you want to be is that money is working for you, not against you. And if you allow yourself to be in debt, you fall on the negative side or the opposite side of the table that I'm showing you here. I just feel like explaining that a little bit. But let me just show you some numbers. So I think most people, even young adults amongst us on the line, can save about $200 a month. The question is, how do we get there? We'll get to that in the course of this training. But $200 a month, it costs $2,400 a year. If you now employ that $2,400, let's say it's returning 10% on an average over a period of 25 years. Maybe in a year it might return 9%, but the next year it might return 12. On the average, it ends up being 10, something like that. That $200 in 25 years is almost $250,000. But what I want you to look at is in the initial stage of its growth. Look at the growth. It's so small. In the first 5 years, you are putting $2,500, into that investment, whatever it is, every year for 5 years, right? The total you have put in would be 2,004 times 5, which is 10 plus 2, that's about 12,000. Look, that means you've only made 2,000 something. And this is where most people get discouraged and they don't want, I've been doing this for 5 years. It's not, but look at what happens between year 5 and year 6. Between year 5 and year 6, you only had 2,400. So it's now about 15,000, but it's now grown 3,000 plus in just that 1 year. Now let's go to year 10. By year 10, that money has now become 38,000. Remember, in 10 years, you only put 24,000 into it, but it's now grown 18,000. Add another 5 years to it. So it took 10 years to get to 38,000. It took 5 years to double from that point. I hope you're seeing what I'm saying. It took 10 years to get to 38,000, but it doubled after 5 years. So it took 15 years to get to 76,000. But in the next 5 years, that 76 doubles again to 135, that's 7,000. This is where compounding has taken over. And that's why I tell people the key to investing is time, 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 time. It's not about timing the market. I tell people all the time. It's about your time in the market. That is what makes the difference. That's why I appreciate the young people that are online right now. You have an advantage that those of us that are in our 50s don't have. Time is on your side. Now, for you, if you're in your 50s, it's not a negative thing. Whenever you wake up, I tell people that's your money. It's just that you now need to double up effort to achieve the same thing that the younger ones have time to do. But it doubles after 5 years from 136 to 237. And then another 5 years again. It now begins to almost double every 5 years. It's amazing how that works. Once you grow the base, the children they born, they seem to work harder than the parents. That is what happens with compounding. And it's because of the power of the exponential function. The exponential function, if you put it on the chart, it goes up like this. Initially, it doesn't grow as fast, but after a while, it takes on a curve. What you want to do is to leave your money in investment to the point that it gets to that curve. The problem with many of us is that once you start investing, after 5, 10 years, you take the money out. The moment you take your money out, you go back to day zero. Then you start counting again. You've lost the 5, 10 years that you just took advantage. You just spent. You're back to day zero. So I tell people, how long should I put the money in the market? I said, you put it for a long time, minimum of 10. And as you see, you can see why I tell people all the time, minimum of 10. About 10 is really where it starts doubling at a faster pace. I was with Pastor Adejumo in their church a few weeks ago, and he showed me an interesting video. I was trying to share that video, but I couldn't pull it, Pastor. So if you have it, please share it with me again. I'll share it or just share it on the group. It's amazing how it works, and it's the same thing that I'm showing here. It takes on a life of its own. I explain to people, money takes on a life of its own after about 10 years, and year 15, it's another rate of growth that it takes on. So I really want to emphasize this to us as participants in this class, that your goal in investing is to let the money stay in that account for a long time, not less than 10. When I say that, it's just to make people think, okay, 10 years is a time. But honestly speaking, the longer you can leave it, the better. So keep that in mind. All right. So when it comes to planning, one of the first things you want to kind of think through, but look at that 200. I mean, in 60 years, and some people might say that's a long time, $200 at about the rate that we know we can get in the market would be between $70 and $18 million in 60 years. I mean, if you can leave that to your children, leave it to the church, leave it to when God calls you home. So we need to be generationally thoughtful in our mind. Let me show us one thing. So this is now the way you think about this. The way you do, and I'll give us an assignment. What you want to do is, I will share this sheet with us so you can use it, as well. And actually, I will give you an assignment that will make you think through this for your own personal finance. If you want to say, okay, I'm age 20, we have some people that are in their 20s with us right now. I'm age 25, for example, and I want to, at the age of 50, I want to have $1 million. So that's just 25 years from now. So the road that I have here is the 50 years. So you're 25, in 25 years you'll be 50. And I want to have $1 million. So you need to look at this cell. I will color that cell. slightly different. Is this cell in red? What this spreadsheet allows you to do is to model what do I need to set apart on a monthly basis and invest at a rate of return that is around 10 to 12 to get to $1 million when I'm 50. So I'll change this to 650 and see what it does. So 650 puts me at 750,000 at 10%, but at 12%, I'm already at $1 million. So if you can set apart 650, you are going to be close to $1 million. But just to be a little more comfortable, I can use 800. With 800, you know for sure you're going to be at $1 million by the time you're 50. That is, even if you don't do any other thing, just keep putting 800 a month. Now, you might say, where do I get into it? That's a different question. But just, thank you, Pastor. Just keep putting $800 a month apart. You will get to $1 million. And this is why I tell people, almost anybody can become financially independent. If you learn, the problem with many people is they take this money and they go to McDonald's today and Chick-fil-A tomorrow. Before you know it, $20, $30 adds up. And they spend money on eating out rather than figuring out. I talked about at the beginning, delaying gratification. The audiobook we listened to also talked about that. We need to learn to figure out, where do I set money out so that I can achieve this? And we're going to do some examples or some exercise in the next class that will help you to think through this. But the way you use this sheet, now that you understand future value, is to think about the future, your goal. Where do I want to be in X years from now? What do I need to start doing today and do on a constant basis, on a continuous basis to get me there? That's the way you use this spreadsheet. So I'll give us an assignment to do that at our own time. And if you have any question, please ask me. But you can see how, this as little as $50. Let me show you $100. Almost everybody can set $100 apart. But if you eat out all the time, you won't be able to. $100 will be between $118,000 and $160,000 after 25 years. That's the power of compounding. That same $100 is somewhere in the range of $4 to $9 million after 60 years. $100. That people just go to the store and just buy clothes that they don't need. So I just want to kind of show us the power of compounding. The key to compounding is time. I can't say that enough. The key to compounding is time. In the early stage, it feels as if the money is not growing, but let it cross that 10-year mark and you'll be surprised what happens to your money. And then if you allow it to even cross the 15-year mark, you will think you have done something that is, I see something else is happening. The money takes on a life of its own, in a sense. Time is critical. There's what is called the rule of 72. Before I go to that, any question on this is one of the most powerful things that, I think I want most of us to get out of this class, this power of compounding and the need to let it work for you, not against you. If you take a credit card, it's working against you. Because the same sheet as it is the same way it works. The moment you borrow money on anything, it works against you. The moment you borrow money. Now, again, there are good ways to borrow money, like you're buying a house. So that's a different conversation. We'll talk about that separately. But anything that does not have an asset attached to it, it begins to work against you. Don't spend money. Don't spend your tomorrow today. I wish I could say this enough. I'm very passionate about this subject, because especially in the church, people don't appreciate the power of compounding, All right. Any question about that before I go to the next slide? And, this slide I kind of got from some of my materials saying essentially the same thing, that the earlier you start, the bigger your nest egg. I won't spend more time on it. Look at the power of $5 invested daily in 50 years is 2.5 million. $50 invested daily, of course, because it's times 10 is 26 million. $50 daily, $5 daily. Can you find $5 to invest daily? I think many of us can. Many of us can. We just don't think about it. I showed you 20, 25 years. You can see it's about the same numbers I was showing you earlier, about 100 and something thousand, you know. At $100 was the one I was showing, but look at 150. 150 is about 100 and 300. It's essentially the same thing that I was showing you on that sheet earlier on in the 25-year mark. You know, 50 years, 2.5 million. If you start at 25, 50 years is just 75. It's just 75. For those of us that have crossed 50, that is, we don't have that 50 years. But maybe not, I shouldn't say that, we can live beyond 100 easily by the grace of God. So anyway, my point is, the earlier you start, the better. The key is time. That's what is called the rule of 72. If you divide 72 by the rate of return of anything, any investment, it tells you the amount of time for that money to double. So if you divide 72 by 25, that is about 2.8, or let's say 3. If you owe somebody on a credit card that is paying, that is charging you 25%, if you're not paying that money up, whatever you owe will double after every 3 years, is what this is explaining. It doubles after every 3 years. Every 3 years. That's why some people will then, I was counseling some couple not too long ago, and they were saying, this must be what has happened to them. I said, yes, it is. Their debt, has doubled, because they were not able to take care of it. So it's important to understand the rule of 72. When you go to a store and they say the store credit is 28%, please, I beg you, don't take it. Don't take it. It's half of a bad I will give Molo a bill. All right. I want to show us this. Now, the question I've had people ask me, okay, I see someone raised up your hand, please.
Thank you again for this class. Thank you very much, sir. I wish I knew this 20 years ago. But again, so every one of us, or just majority of us that came from Africa, we have this fantasy or illusion of American dream. And this, that is what has been sold to us.
Yeah.
You come to America, you have access to credit, you get credit card, you get car loans, you get all these things, you live you're essentially living your future today, as you said.
Yes, sir.
So, this class, I think that you probably have to, maybe through the Pastors Forum, make sure that our youths, those out of college, those who are finishing, or those out of college or who are going to head college, that they get access to this information. Because I've seen some of our youths that the credit card companies are working extra time.
Yes.
Give them credit that they are not using. My daughter, she had a credit card that I told her, make sure you stay below like 30%. She eventually finished it. She finished the 100%. She maxed it out. In fact, when they had it at interest, it was above the max out. It was just only $1,500. But that's a lot of money for somebody who is a student who is not working, right? And then the other day, I got statement came in, and they've increased the credit limit to $2,500. Somebody that was owing you, that maxed out $1,500 and balance was about $1,600, and now you increase it to $2,500. This is unbelievable. And this is happening. I'm sure she's just an example, but this is happening to almost young people everywhere. But this company, this table that you showed us is an amazing table that I think maybe if they understand it on time, they won't be in our own situation. My situation now, I thank God, but I have to work double to meet up all those numbers. But I think that the American dream has been oversold, and the idea that we have when we left Africa of an American dream, and of course the demand from Africa too for some of us,
Mm.
You know, it's sucking out the money that we will have to invest, because now it is essentially you carrying the hope and aspiration of a whole clan in Africa, and you sending that person's child to school, you paying that person's health fee, you know, hospital bill, and all this money going back home. You know, he's not going to come back. And how do you invest with all these things?
Pastor, you are hitting the nail on the head. You know, that is why the youths are I'm so passionate about this. And sometimes when I speak to some youths, it's like, do you really understand what is going on here? The system is designed to plague on ignorance. It's sad, but that is just the truth. That's why they're giving that young person, your daughter, you know, because they feel they want to suck that individual in. It's easier to spend credit. You almost feel like it's not money you're spending. And it's so sad that money just starts doubling and doubling, and before they know it, they are under a weight of debt. They have student loan, they have this loan, they have that loan, and then, you know, even in marriages, it's affecting marriage, and I've seen that over and over again. So, Pastor, I'm very passionate about this, especially for youth, because they have an advantage. And my desire is that the system does not take advantage of them. They want to. The system really wants to. I hear your point. I mean, I'm hoping there will be some opportunities to kind of talk about this even more among pastors and share it with you. You know, I love to do this, you know, so that they understand what the system is designed to do. It's designed to take advantage. And that's why they will raise the credit limit of a young lady, a young guy, because they know that individual, if they can suck that individual in, then you become, the Bible says that the borrower is a servant to the lender. They know that person automatically become their servant almost for life in many instances. Now, there are ways to kind of get yourself out of debt. We won't get to that today. But it's so critical, as you said, Pastor, that if you're under debt, then there's no money to invest. I mean, in fact, when I teach, and we'll get to this, you don't start investing unless you take care of your debt first, because that money is going to be counter to the effect is countering your investment. So you're not growing anything, you know. So, Pastor, I mean, I hear you. Look forward to more opportunities to share this with our youth. We have some young people online today, and my desire is that they will keep this in mind. Thank you for that contribution. And, you know, in each of these sessions, I hear people say something very similar to what you say, Pastor, that I wish I knew this, you know, when I just came. I wish I knew this 20 years ago. I pray that God will help us. Let's pass this on to our youth, but more than anything, I'll be more than happy to share. Thank you, Pastor. You know, I wanted to show us this as we kind of begin to round up. I'll give us some assignment to internalize some of what we've done today. This is the average return of the stock market. You can see the chart. Some people say, stock is volatile. I don't want to invest in stock. And I say, what is volatile is your ignorance. You know, if you don't learn to take advantage of what the system already has for you, you will struggle. But that's on investing. And I will share, you know, I will go into the detail. That's really the meat of this training. What do you invest in? How do you decide? How do you, and all of that. We'll get into that. But I just want to see that even though this is for, how many years is this? This is 1998 to 2020, 1988. That's like almost 30 something years. The overall trend is upwards. Yes, there are, if you just look at it, you know, normalized around zero, it goes up and down. That's not the problem. But the point is, with the power of compounding, the overall trend will always be up, because companies are always going to grow. And you can look at the overall average here. So for S&P, somewhere in the range of 13.6%. You know, Goldman Sachs, you know, did some analysis. They called it 9.2% over 140 years. You know, but this is the average for S&P, you know, over this kind of period of 10 years or so, like 13, 14%. So I'm saying, you know, there will be times it will be negative. It doesn't matter. Leave the money in the market. And there are times that maybe you need to do some things to protect your downside very, very well. But leave it in the market. It's going to come back up and it will turn around. All right. I like to kind of say this, that if you buy an iPhone, you are a consumer of the product. But if you buy one Apple stock, you become a part owner of iPhones. If I'm using an iPhone, I want to be a part owner of the company that sells iPhone. The challenge, and I've said this, is to stay long in the market enough to benefit from the overall returns. People sell out when the market is down. That's not the right thing to do. You know, your goal is to be bullish. What they call bullish is, you know, to be bold when others are afraid, when they are scared. That's how you make money. You need to maintain a long-term perspective. I've said this, of a minimum of 10 years. Don't just jump in and have a plan and work your plan. You know, I'll talk about various investment vehicles. I'm going to explain all of this very, very well, so that at the end of the class, you know exactly what all these various things, bills, bonds, stocks, and stuff like that, what they mean. I'll explain that. So our closing exercise today is really twofold. I will share the compound interest spreadsheet, that same model that I shared with us earlier, that Excel. I will share it on the group. Please do this exercise using the compound interest and future value analysis worksheet. What is the value of investing $100 a month in 5, 10, 20, 30, 60 years? I actually already just did that for us today, but do it again at the rate of return of 10 and at 15%. Question number 2, I am 25 years of age and recently finished college. I desire to have $1 million in investment at the age of 50. How much will I need to invest monthly to achieve this goal if my cumulative rate of return is 12%? Again, I kind of walk through that, but I want you to do it again yourself. If I invest only $200 a month, but I do so consistently, at what age will I achieve 1 million? I didn't do that exercise today. I want you all to use that sheet to do that. I invest on $200 a month, and I do so continuously. At what age will I achieve $1 million? Another assignment is around goal setting. I said, as a preparation for the next class of budgeting, please determine your personal and family investment goal. Again, you use that sheet, like I explained. Okay, let's say as a family, when we are, you know, X years from today, we want to have a net worth in all our investment that is valued at $5 million, for example. Okay. You need to kind of think through that, determine that goal and have it written down. I'm not asking you to show me, please. You don't need to, but have it written down. The Bible says that write the vision down, that you may run that reads it. You know, you will need to, I said you will need to use the future value template to evaluate your monthly savings. Excuse me. Savings and investment requirement to achieve this goal. Let me ask us a question. Based on what I have done today or explained to us, do you feel you can do these exercises along with the one that I said earlier on? So I will share this sheet, the one on the net worth and bond rate. Do you feel you can do these 2 or 3 exercises? Is it clear what
Yes. Yes.
Yes, sir.
Excellent.
Yes.
So I'm going to send to the group, I'll send this slide so that you know the question. I'll send this slide along the same lines, and then I will send this slide, you know, as well, so that you can calculate, you know, this net worth, bond rate, and run rate for yourself. That is where we'll end the class today. All things being equal, by the grace of God, we will do this the 3rd week of October again. So that will be October 18th. Same time, 6 to 8 p.m. By the grace of God, they will take it to the next level. Then we'll start talking about, let me actually show us what we're going to cover the next class. So the next class, we'll look at the steps 3 to 4. Then we'll go through budgeting, and then we'll start looking at investment vehicles. Once I know what I want to get to, once I know what it takes to get there, how do I then, where do I put my money to achieve that goal? Those are the various investment vehicles that we're going to be talking about. That will be the focus of class number 2. So thanks everyone for participating tonight. I appreciate you taking out the time. I ask that you please, think about some of what we've talked about today and think about how you're going to apply this in your personal finance by walking through the exercise that I will share with us. All right. So I see, Pastor, you have your hand up.
Yes, sir. Just a quick question. Because it looks like there were 2 differing opinions in the books that you told us to read. I mean, that you asked us to read before the class. There was one of the authors that said that it's not a good idea for you to use your insurance as a saving instrument. And then there's another author that said that you could build cash value, into a term life insurance.
Yeah.
So, I mean, I have a term insurance, which is going to expire soon, but I just don't know, for the benefit of everybody, what's your thought about this?
Yeah, so insurance is good, but you need to be careful with insurance. It's actually good. So insurance is like a contract, right? You give them your money today, they'll promise to give you some money, either, in terms of, some it's as a surrender value, that is, they'll give you some things back at debt, or some it's like they give you some things back even without dying after a particular amount of contribution that you make to it. So it depends on exactly what you buy. If not, the term insurance, on the other hand, really does not have a surrender value in a sense. If something happens to that individual over that period, then it will take care of that individual's family. But if not, it's essentially gone. But there are other, types of insurance that has some surrender, but they give you some money back after X number of. Those ones, structured properly, can be part of your long-term investment. If not, insurance is more for protection. It's really more for, if in case something happens. However, there are some insurance contracts today, life insurance, that are surrender value. They give you some money back at particular interval in the future. So those might be, they were talking about 2 separate things, but did not really clarify it separately. Does that make sense?
Yes, sir. Thank you, sir.
Yeah. So I am a strong believer in insurance, by the way, Pastor. I mean, I think, it's a good way to have your downside protected. Even if it doesn't have, because most of those that have some kind of surrender value or some cash value, they're usually a little bit expensive. But even if it's to protect your downside, it has value. Yes, Sister Tomlena, I see you have your hands up too.
Yes, sir. Sorry, this would be a basic question, but I just wanted to ask, when we were talking about not putting our money in a savings account that's like a normal savings account that's equivalent to cash, but putting it in the money market, when we say money market, is that different from stocks? And
Yes.
if so, what does that mean?
Yes, it is. Next class, I'm going to start talking about various investment vehicles. Money market is, so the market generally, where stocks are bought, bonds are bought, bills are bought, and everything is referred to as the market. But when you use or hear the term money market, it's a very specific term, where the money that people put into like savings, that they are not investing. The banks actually invest that money, in short-term instruments, and they will pay you an interest rate. Now, it's a floating interest rate based on what is going on in the market. They pay you. It's not a fixed interest rate. Like if you buy like a CD, the CD will have a quoted interest rate. CDs are actually good investment today because remember I explained the Fed rate earlier on of around 4 to 4.25% right now. CDs are paying around that rate because that's about, so they'll put money into that, but that is fixed. However, the money market, they will loan maybe somebody that wants to do a quick business, get money. So they'll use your money. They don't, any money will keep in the bank. They don't just keep it in their box. So they are required by law to keep, I can't remember, I think it's like 10%, whatever, to keep some amount of money so that people, if they call, they can get their money. Everything you put in there, they are always loaning it to somebody else. So the money that they make from that, they will pay people back. If your money is placed in that money market, they'll pay you a floating rate based on what they get back. And it's usually, generally a little bit lower than the the CD, a little bit. Usually it's around the CD, but it's a floating rate. It's not fixed. That's the difference. So you might get more, you might get less. You might get up to 0.25% more. So it's not a fixed rate. So anyway, the term market generally talks about, where all the investments are happening and all of that. But money market is specific to taking your money, putting it into short-term investment and giving you a floating rate return on investment on it as an investment. Yeah, as long as it's not in a checking account, that's what they do with your money. All right, good question. Yeah. All right, everyone. I think it's been a great time tonight. Let's have a good evening. And by the grace of God, we'll continue on the 18th of October. I appreciate your time. I'll send the questions to the group.
Thank you.
All right. God bless everyone.
Thank you so much, sir.
All right, sir.
Thank you, Uncle Larry.
Thank you. You're welcome. God bless everyone. Good night.
Thank you.
You bet. Good night. Bye-bye.
Thank you, sir.
Thank you, Pastor. Good day, sir.